This lecture is on vineyard and winery accounting. So this is the business side of things that was provided to me by Kurt Golnick of Scheid Vineyards, who provided a lot of things for this class to get it off the ground. And he was kind enough to share some of this accounting information. If you're interested in this side of the business, dig in a little deeper. I'll tell you the kinds of things that I want you to know for the final exam. But we'll look at basic winery financial statements, which is true of any business. It's not like wineries have unique financial statements. These are things that everybody should know about, regardless of the type of business you run. The costs and revenues, depreciation, and vineyard financing. So these are some of the major topics that Kurt provided here. Oh, and vineyard valuation analysis. So if you're going to get a valuation or appraisal on a vineyard for purchase or sale, that's also really important. So first, the basic statements. There's a balance sheet, a statement of income or loss, a cash flow statement, and also footnote disclosures, which that's really important. I don't usually lump that in with the primary three documents, but certainly you do need to have information to tie things together and have proper disclosures for the bank, for investors, for legal reasons. So it is really important from an accountant standpoint, but unless you're in a business class, an accounting class, something like that, I usually don't even mention the footnote disclosures. Gorgeous. So costs and revenues. There are types of costs, the allocation of costs, types of revenues, and you have to categorize things. Costs are things that cost you money. You're spending money. You have to pay workers. You have to buy bottles. If you're a winery, if you're a vineyard, you've got to buy sulfur and fungicides and fertilizers, right? Costs. So this is from the winery perspective, because Kurt is at Scheid, which his major focus in operations is the vineyard itself. There's a heck of a lot of money and costs that go into a facility like they have down there in South County. So here you can see major expense account categories for a winery. Certainly buying the grapes, huge. Bulk wine, you're buying in bulk wine to blend with your other wines. Bottling costs, labor, you've got all the labor. The cellar workers are the people that are actually moving things around in your fermentation tanks and presses and filters and on and on. All of the grapes and juice moving around to go from when they first come in from the field to when they finally go into aging. Those are your cellar workers. You got your lab personnel running all of these TAs and soluble solids and other types of phenolics and et cetera. Some of them they do in-house and some of them they send out to do in another lab. You got your winemakers, maintenance people, fixing buildings, fixing pumps, fixing all sorts of stuff. And then management. You need supervisors and department heads and quality assurance, et cetera. Then you got the other expenses, all the additives, things that we've talked about, like the wood oak staves or the yeast or the malic or tartaric acid or something, lab expenses, cellar supplies, et cetera. I'm not going to go down on all of it, but you can see the kinds of things that are important. Plus you have benefits. All of those workers, you got to pay for their health insurance, payroll taxes, 401k plans, workers' compensation insurance. You can see here, Kurt's old like me, workman's compensation. is the old term. It's now workers' compensation. Liability and other insurance. So liability insurance is if something goes wrong, one of your employees gets in a car accident, falls off a ladder, whatever. Other insurance could be fire and loss insurance for the building or things of that sort. Utilities, PG&E, water, etc. And then depreciation. Depreciation is when you have an asset that is very, very expensive. You can't just buy a building and then write it off on your taxes as an expense. The IRS, Internal Revenue Service, for taxing purposes at the federal level and the state level as well. IRS isn't state level, but our, what do they call, the Franchise Tax Board in California, they require you to depreciate expensive, long-lived assets like trucks and cars, winery equipment, buildings, and they have an expected lifespan. And so let's say I spend $100,000 on something that's expected to last 5 years in service. I can write off of my taxes, I can depreciate $20,000 a year for 5 years because it's an asset that's going to last for 5 years. If it's going to last 10 years, I can only write off $10,000 a year for 10 years to get to that $100,000, etc. But you basically use depreciation as a way to offset the costs of expensive items that live for a period of time. You depreciate the costs to reduce your income or your taxable income. So for example, if I go back to that $100,000 item I bought, if I can write off $20,000 a year for 5 years, then the first $20,000 I make, I don't pay any taxes on it because that $20,000 of profit is offset by the $20,000 that I spent on that item. And if you keep pouring money back into your business, you can offset a significant portion of your income, and that's okay, that's fine. A lot of people talk about businesses not paying their fair share of taxes sometimes, and maybe you've heard things like that. There are certain loopholes that I don't necessarily agree with, where only the super rich can take advantage of some loopholes, but the idea that you spend money to build your business and then you can take that away from profit, that's normal. That's something I think anybody who knows anything about business would support. That's not considered some sort of a loophole. That's just depreciation or expenses. Anyway. Property taxes, permits, fees, there's lots and lots and lots and lots and lots and lots and lots of things that go into the detail of expenses. This is just kind of the big categories. So that's money going out. What about money coming in? Processing. You've got to press those grapes, you've got to de-stem, you've got to ferment them, you've got to do all kinds of things in processing. What about the juicing? What about the storage? You've got bulk storage, barrel storage, case storage. They got to go somewhere, and you're paying for that square footage of warehouse or cave space where you are doing your storage. The cellar is where you make the wine. The cave is where you store the wine, just in winery terminology. And also bottling. Each one of these things, depending on how you look at it, is money going out and money coming in. If I'm processing for somebody else, they pay me for it. If I'm juicing for somebody else, they're paying me for it. If I'm storing for somebody else, they're paying me for it. And a lot of big wineries will do business with other companies and make money doing all of these things. It's not just the final sale of wine. Now, certainly that's not even on the list, but you know, you've got your final product, you're selling your product to your customer, whoever that is, whether you sell to a wholesaler or you sell directly to the outlets, you sell to restaurants, Safeway, Nob Hill, Walmart, whoever is carrying your wines. That's another source of revenue. But keep in mind, you've got machines that you need to keep running. You've got warehouse space you've got to keep running. So the more you can keep people and equipment busy, the better off you are. And there are a lot of smaller operations that they just want to grow the grapes and do their own custom fermenting, and they don't want to handle, maybe they don't want to handle the pressing or the bottling or something like that. They just want to do part of it. And they can do that and hire somebody else to do the parts that they don't want to take on. What about financing? Several different sources of lending. You know, you can go to banks, you can go to private investors, but you need to get financing to get started. You need fermentation tanks and presses and filters and hoses and pumps, and you need a lot of stuff to get started. Not only the stuff, but you need buildings to put it in. You can lease buildings, but you've got to put money down to get into a lease for some commercial property of that scale. And there's this concept of loan to value ratios, and they change depending on what kind of property or equipment you're buying. So for example, if you're a consumer, you might be used to the idea that you can go in and maybe buy a car for no payment down, you know, $0 down. That's not true in business. Business, it doesn't work that way. People are trying to suck you in to get you to buy something that might be over your budget and too much to pay. Zero down is a dangerous thing to do, but consumers often don't have down payment cash on a car. And it was the same with houses before the big burst of the last bubble burst in our economy that took us crashing back in 2008, 2009. That huge recession, depression was largely because so many people bought houses way beyond their means without enough down payment. And when the market turned around and people couldn't refinance, the whole thing came tumbling down. But that's private. What about business? Business, you often have to come in with 30, 40, maybe 50% down on certain types of purchases. It depends on the type of purchase. It depends on the bank. But you've got to come in with a lot of money. You've got to have cash in hand. Say, all right, I want to buy this building. And if the building and property is $1 million, I might have to come in and lay $350,000 on the table, cash, and the bank will put up the rest. How many people have that kind of cash? So you need this loan to value ratio concept, because businesses are a risk and they're spending a lot more money and they're doing bigger loans, much bigger loans than the typical homeowner buying a car or a house. And so the banks need to make sure that whatever money they have in that business, in that equipment, in that building, if the person taking the loan or the business taking the loan defaults on that loan, they can get their money back by selling it, because they know that the value is $1 million. They only loaned $700,000 or $650,000. Even if the value of the property went down, the bank should be able to get their money out. So sources of funding: traditional banks, farm credit system. That was created a long time ago. If you go back in history of humankind, the idea of lending was a foreign concept, and people would actually go to debtor's prison if you couldn't pay your debts, and only people who had money could borrow money. There was no such thing as credit cards. There was no such thing as personal loans to buy a home or a car. That's a modern concept that really has been in since the 20th century, the earlier parts of the 20th century, starting coming out of World War I period, World War II, and that range, the concept of credit for the average person started to evolve. And because of the Great Depression back in the 1930s, the farm credit system was developed because the government realized a lot of farming, especially back then, most farming was small business. Even today, there's a huge percentage of farming and farm products that are small businesses. And small businesses can't operate unless they have capital. And so the US government created the farm credit system to support small farmers that don't have the big cash leverage ability of big businesses to allow them to get what they need. Because the government also recognized the fact that the economy depends on agriculture. Agriculture's the foundation of our economy. You could argue that 50 cents of every dollar in this country is related to ag in one way or another. Safeway wouldn't exist without ag. So even though that's not farming, that's still related to it. What about trucking? That's not called agriculture, but what percentage of stuff being carried on trucks is related to food, paper, wood, clothing, things that trace back to agriculture? A huge portion of trucking is related to ag. So anyway, the government created this farm credit system, and it's a tremendous value to agriculture in the US. Insurance companies, that's relatively new. That's, and I shouldn't say relatively new, now I'm looking old. This is something that, because of the crash of the Great Depression, banks, investment companies, and insurance companies were all split up, because that's one of the reasons why we had the Great Depression back in the 1930s, because all the people handling the money were the same people. So the investors, the bankers, and the insurance company, they're all the same people. And because of that, they started making some very creative business models that put the economy on this house of cards that was not good. And it finally collapsed. We had the 1930s depression. There was a lot of push to allow banks, insurance companies, and investment companies to get back together. And that was done under President Bill Clinton. One of the things that I just cannot believe he did, but he did it. And I think it was a absolutely asinine, stupid move. But there was a lot of big business push to do it. There were a lot of things that I think Bill Clinton did that wasn't on my best of presidents list, but he did a lot of good things too. So, you know, I'm split, but I guess I'm split with most presidents. Anyway, the idea that we went back to insurance companies now being able to give loans and do investments, investment companies being able to bank and do insurance, they're all mixed up again. And nothing you can do about it other than look for a good deal. And insurance companies are one of those places where you can look for money. And REITs, real estate investment trusts. I won't get into the details there. You can look up REITs. You can set things up to get investors to invest in these trusts, and they can be a great way to organize some funding. So I'm going to take a quick break and be right back.